This is John Paul Mendoza, Dr. Speed Selling. This is the Raging Verbalist number 89. This is a special edition. I have a great interview that I did live in Rapid City, South Dakota at Freedom Fest. Wanted to just make sure I put this up for everybody to see. Adrian Day, guy is just so smart, so interesting. He is a stock analyst, a market seer, all of those things. It's one of those that you never know when you start these interviews where they're going to go. We captured some really good insight, and I think you're going to learn a lot. Hopefully what you're going to do is you're going to come away from it and say, wow, John, do more of these kinds of interviews, which of course I will be working towards. So without any more hesitation, from London via Puerto Rico to Rapid City, make that all work out. You're going to see myself and Adrian Day in a very great and interesting conversation. Enjoy. We'll see you at the end. Hey, welcome everybody. This is John Paul Mendoza. This is It's a Paul World. We're at Freedom Fest. We have conjured up, I think, a great interview for you if you're interested in money. He's a money manager. He's got 30 years of experience, London School of Economics, and he is with us today, and he's going to talk about a variety of topics. And of course, if you're not interested in money, well, you'll still probably learn a few things here or there. And my guest is Adrian Day. Adrian, welcome.
Thank you very much. And may I correct something in your introduction? I didn't go to the London School of Economics. I went to the London School of Economics. Okay.
A common people separated, or like people separated by a common language, or however Churchill said it, or whoever said it. But you're okay. That's good. No, that's fine. Keep me on the straight and narrow. Lives in Puerto Rico today, and so talk a little bit about the whole monetary situation today, which seems to be out of whack globally.
Yeah, it's completely out of control. I think the problem is that the Federal Reserve and other leading central banks around the world, particularly the National Bank of Japan and the European Central Bank, they have pursued easy policies for too long. And so that has very distortive effects on the economy as well as on investments. It distorts everything when you have negative rates in Europe and when you have ultra low, excessively low rates in America now. Of course, excessively low rates. If you own a house and you refinance a mortgage, you think, hey, I'm glad we have these low rates. But when you have rates that are lower than they, quote, should be, which is a whole nother subject, but when you have rates that are lower than they should be, then it distorts people's decisions. And so you have what we call zombie companies, companies that are propped up by debt and really should have been taken out the back and shot years ago. And you have all sorts of, in investing, you have distortions. So in economic terms, we say the Fed's creating excess liquidity. Excess liquidity, by definition, is liquidity in excess of the current needs of the economy. When you have excess liquidity, that excess liquidity has to go somewhere. Right now, we can talk about what happened after the great financial crisis 2008 if you want, and why we didn't have inflation and why we had the slowest recovery in American history. We can talk about that separately if you want, but in the last couple of years, this excess liquidity, it definitely goes to stocks, it definitely goes to bonds, it goes to real estate, and for every person that's happy with ultra-low interest rates because it refinances their mortgage, there's another person who may not realize it, but ultra-low interest rates are a reason that he can't afford to buy a house.
Describe why that is, because I think a lot of times people don't understand. They think, well, if the rates remain very low, that means it's going to make it easier for everybody to buy a house.
Well, the problem is when rates are so low, it means investors can then buy things. And one of the things that they've been buying is real estate. So they're just bidding up the prices. So the poor young married couple that are working and saving, they just don't have enough money to compete with the big institutions from New York that are just buying up, street loads of real estate in towns around the country. And then you also get idiotic things like, these NFTs, 12-year-old sneakers going for $18,000 or whatever it was. The latest one that I read about, and there'll be another even more absurd thing tomorrow, I'm sure, but the latest one is an Italian artist who sold literally air. It was a piece of art that he called nothing. And it was $18,000. Now, who pays $18,000 for that? The fact is, you only get these kind of absurd excesses because the central banks have been creating excess liquidity. So anyway, it distorts everything and has negative effects. Now, there's so many negative effects to it. I mean, gosh, I'll stop and let you ask a question, but let me just say this. The most obvious negative effect is on middle-class savers. People who have worked hard all their lives, put money in the bank, haven't taken risks, been ultra-conservative, middle America type people, put money in the bank, rolled over their CDs, planning, he's done his calculations, the husband has, and they can live in retirement comfortably. Well, they can't live in retirement comfortably anymore because they're getting, less than 0.5% on their CDs now. By a 10-year treasury, you're getting 1.6%. They can't live on it. They were calculating for more. And so what we've done is we've destroyed the middle class with these ultra-low policies, and we have turned retirees into speculators because they have to speculate, because they can't live on what they're earning.
Well, and you are really hitting some very important topics. One of the ones which I would absolutely agree with you is that the speculation, the striving for higher yields, is pushing people to buy investments, quote-unquote investments, that are in very speculative things, which when they unravel will just blow up. And I find that to be a rather disturbing trend. And so talk a little bit about that, because there's some crazy deals out there.
Oh, absolutely. I mean, we all know the crazy deals with GameStop and AMC. I mean, frankly, I think Bitcoin and Tesla are way overvalued, but some people will debate me on that. What I think we're moving into a period in the stock market, I know this isn't quite what you asked, but we're moving into a period where rather than the whole market going up and then maybe having a little pullback and then going up, we're now beginning to see separation. So if you look at this year, for example, the S&P is up and the Nasdaq's up. They're all up quite nicely. Right. But if you look at individual stocks, we have the widest disparity that we've had probably for 25 years. So you have a lot of what we call in the market bad breath. We have bad breath, where a lot of stocks really haven't done very well. And I think we're going to continue to see that. I think the market's going to continue to go up just because excess liquidity has to go somewhere. And most people put it in the stock market, not in 12-year-old sneakers, most people. So the stock market will continue to go up. But I think we're going to see a market that's much more volatile when it comes to individual stocks. Right. And when stocks go down on bad news, company comes out with bad earnings or whatever, they drop very sharply. So I think a lot of people, one of the most dangerous things to me is, and you've got to be careful how you say this because it can sound a bit condescending. One of the things that's very worrying to me is neophyte investors who believe it's so easy. I've heard so many of my friends say, oh, my 16-year-old kid is sitting in his bedroom, and he's not playing games anymore. He's investing on Robinhood, and he says it's so easy. Why didn't you tell me about this earlier, Dad? I could have made more money. Well, it's not easy. Investing is not easy. The best thing that can happen to a new investor is to lose money with your first investment. That happened to me. It's a wake-up shock because you realize, oh, I'm not as smart as I thought I was. Maybe I need to do more homework. But I think that's very dangerous, and another very dangerous thing is the amount of money in the market that is borrowed money. A survey that came out last month showed that over 50% of money in the market right now is borrowed. That's astonishing. Some of it might be margin loans, but some of it is just money that people have borrowed from somewhere else. For Gen Z, whatever that is. But I think they're young people.
Yes, they are.
Okay, I'm not very good at these new terminologies.
Now understand, well, and by the way, these keep morphing a little bit. There used to be a very tight, because of my focus is in the marketing world, used to be very tight in demographers, but now it's kind of gotten a little squishy because it's a way to cook the books, if you will. The demographic books get cooked. So when you say Gen Z, where do they all fit? It's because it's easier to cook the books that way.
I gotcha. Well, this survey showed that Gen Z, over 80% of Gen Z people had borrowed money to buy stocks. That is extraordinarily dangerous. Because, of course, if I buy a stock at $50 and it goes to 100 and goes back to 50, I can shrug my shoulders, but I can still survive. If I borrowed money and it goes up to 100, when it goes down to 50, I get a margin call, and I have to sell. By its nature, investment margin calls come when you don't want them, right? They come when the stock's down. You never get a margin call when the stock's up. So I think it's extraordinarily dangerous, and I think a lot of people are going to, unfortunately, lose money.
So do you, as you look out, do you see that we're going to have some correction? Because we haven't had a correction in quite some time. I mean, people talk about the correction in 2020, but the correction was this global shutdown and a fear factor. But today, it seems like we just keep going up. I mean, as we're recording this, we just hit 35,000 in the Dow for the first time. Seems like everybody, as you say, everybody thinks like they're a genius and making money, which again, from my gambling days, whenever you find a group of people who are geniuses, I would always go up and try to start betting with them. Only with cash, though, mind you, Adrian. No markers, because you know that they're not going to be good for the markers. So do we see a correction in the offing?
And as you say, March last year was an extraordinary event, but also note, after March last year, the market came back so quickly.
Right.
Are we going to see a correction? I think the Federal Reserve is over-focused on what the stock market's doing. And that's important, because no Fed chairman wants a market crash on their watch. And we saw at the end of 2018 the temper tantrum, where the Fed raised rates twice and then they pulled back from that because of the market decline. Just look at June to see how far we've come. In June, the Fed said we might perhaps think about raising rates 2.5 years from now. The S&P went down 1.3%. That's nothing, 1.3%. But 7 Fed representatives, members of the Federal Reserve Board and regional governors, 7 of them in the next week all started to talk back about raising rates. Right. They are petrified of the market going down. And so they are going to continue to print money. And again, so long as there's excess liquidity, it's going to go into the stock market. So how do I see it playing out? I think we're going to see certain sectors. I think we're going to get rotation, more rapid rotation. We went from growth to value earlier in the year, and now we've gone back to growth and tech. I think we're going to see more rapid rotation. We're going to see specific sectors, let alone and specific stocks, have sharp corrections, particularly on any kind of bad news. But I don't know that we'll see a meaningful, and by meaningful I mean 20%, not 1.3%. I don't think we're going to see a meaningful correction in the stock market averages in the near future. I may be wrong, but I don't think we're going to see that until the Fed actually starts raising rates.
Well, and we don't know when that's going to be. No. So let me talk a little bit about the whole Robin Hood phenomenon, and getting all these people in there who don't know a thing or two. And what I've told people, because I actually have friends, I have clients who have done it themselves or other people, and I trade options myself, so I understand the risks. I mean, I understand what you mean. If you have the lucky win in the beginning, you're hooked, and it's the next 3 or 4 that you lose that you learn that you're not so smart. But as I've talked to them and counseled them, in fact, I had somebody who was sitting on a bunch of game stock that fabulous gain. And I said, sell and get out. And he says, oh, no, we're driving the hedge funds to the sea. And I said, there is no money in driving someone to the sea. There's only money that you can extract from the market. So talk about this phenomenon, which is that they feel they're on a crusade and a cause, which I have never, you may disagree, I have never believed that ever resulted in a way to even be a wise speculator, let alone an investor.
No, that's absolutely true. And I mean, we all have, for example, we all, at a lesser level, we all have, political beliefs and principles, I should say. And if you want to make money in the market, I'm not saying you should leave your principles behind. I don't mean that at all. So, if you're a pacifist, don't invest in Northrop Grumman. I'm not saying don't keep your principles. I guess what I'm trying to say is betting with your politics is not a way to make money. And crusades, such as you're mentioning, it just doesn't work in the long run. Yeah, I mean, I know I had a similar example to you. Someone, I won't say who, but a relative emailed me and said, a young relative emailed me and said his girlfriend had just made an awful lot of money on some new crypto that I hadn't even heard of. Yeah. And, she was up 500% in 10 days or something.
Wow. And
what do you think she should buy more or something? And my answer was, look, my experience is when you have anything go up 500% in 10 days, you need to sell at least some of it. Frankly, I would sell it all and run for the exits. But if you're not so inclined, and say thank you, I got a great win, thank you, God. I would, but if you don't want to do that, at least sell half of it. Take money off the table, preserve some of your winnings. And, I gave a rationale, but I didn't argue about this particular thing because I didn't think that was the way to go. I just said, in my experience, 500% increases in 10 days, they just don't keep on going up forever. And, so anyway, the person sold everything and was very, very grateful. But, and I said, and be patient before you make your next investment.
Well, and I'll share with you a quote. I cannot find this book for the life of me, but it was about all types of bear markets and panics and crashes that I had years and years ago. And this Dutch trader from the 1600s said, and maybe you would agree with this, he said, money has no memory and respects no borders. Yes. Use that as your axiom, and you will always become more profitable.
Yeah, no, that's very good. Money has no memory. That's very good, and that has many, many connotations. One connotation is the market doesn't care what price you paid. If you've got a loss and you're waiting for it to come back to where you bought it, they don't care. The market doesn't care what price you paid. And what price you paid is in the past. You got a gain, you got a loss, it's in the past. You've got to look at where you are now and make some kind of analysis on what the future holds. The only reason a loss is important is so you can write it off on your taxes. That's the only area in which it matters. That's a very good. And talking about Dutch in the 17th century, as you just did, makes me think of bubbles, of a tulip mania in the 1630s in Amsterdam, where tulip bulbs were turning over 8 to 10 times a day. Right. The same tulip bulb was being sold in the market, bought and sold 8 to 10 times a day, and a single tulip bulb was priced at the same price as a house in the middle of Amsterdam. Now, Alan Greenspan, former Fed chairman, says in his defense, you can never tell a bubble when you're in it. You can only tell a bubble after it's broken. I say that's absolute BS. Can I say that?
You can say that. You can say even.
I've
gone far there, so
okay.
So we have an adult crowd.
I don't think that's true. Of course, there's argument about whether something's a bubble. By its nature, if a price is where it is, I might think is grossly overvalued, but by its nature, someone else thinks it's worth buying.
Right.
So that's why we have that price. So of course there's always debate. But I can tell you something, when I say to people that I think Tesla's in a bubble, they say to me, oh, Elon Musk is so brilliant and he's going to the moon and he's doing this and he's doing that. And I'm saying that has nothing to do with Tesla. Have you looked at their revenue numbers? Have you looked at their quarterly revenue numbers? Have you looked at their profit projections? That's what matters, not whether he's digging tunnels in Las Vegas, right? Now, I may be wrong on it, but I'm just saying. But there's always a counter-argument. There's always people believing the opposite. And you know what's really interesting about the Dutch tulip mania? The Dutch tulip mania, for those who don't know, is regarded as the kind of epitome of a mania. How could people be so stupid? We laugh. But they would pay the equivalent of $150,000, $200,000 for a single tulip bulb. Well, there were people that believed in it. There were people that gave arguments. These are rare. These are beautiful. And you know what? The English and Russians have just started buying. There's a whole new market. Haven't you heard that before? The Chinese are buying now.
Oh, yeah.
The German Gigafactory is going to come online. Oh, my goodness. Come on now, Adrian. Oh, it's happening.
Exactly. So there's always people that will give you arguments for why something's going to continue to go up. I don't think the market is in a bubble. But one thing worth remembering about the U.S. market, the S&P is now 2 standard deviations from the mean. It's at the highest valuations, and valuations itself almost seems like an old-fashioned word, doesn't it? It's at the highest valuation since the eve of the 1929 market crash. That's almost a century ago. We're at the highest valuations, but 2 standard deviations from the mean for the entire market. But I don't think it's a bubble, because bubbles have certain criteria. They have exponential rises, but I think some sectors are bubbles. I think Tesla's a bubble. I'm going to get emails on this, but I think Bitcoin's a bubble. I certainly think Dogecoin's a bubble. Dogecoin is valued in the market at more than Kraft, Heinz, and United Airlines combined. Now, does that make any logical sense? There is no sense in that at all. It is purely a game. It is people buying something, thinking they can push it up. If we all get together and we all buy it, we can push it up, and let's do some tweets or whatever, and send them out and get more people, and there'll be someone we can sell it to later. There's no one in the world who is buying Dogecoin because they think it is good value. No one that I know of, anyway.
I agree. Well, let me talk about Tesla for a second, because I will step out into that pool. He is following a model from your fellow countrymen in Aston Martin. And what most people don't know about Aston Martin, which just got bought out again by somebody else, is that if you take all the cars that have been built, and they're beautiful cars. I've driven one. Unbelievable. Great grand touring cars. Wonderful. Would love to get it out on the highway and do what it can do. But all of those cars have a glove box. I don't know if you call it a glove box there. And when you get your Aston Martin and you open it up, there's $1,000 bills in there. They don't even print them in the U.S. There's $1,000 bills or £1,000 notes or 1,000 euros, because they've lost money on every single car they've built since their inception. They're a car company that has defied logic. This is a proof that we have gone through the looking glass and we're on the other side. I didn't know if you knew that or not, but they've lost money on every one. I mean, at least Ferrari made money on his street cars. He made a lot of money on the street cars. Fiat helped, but he made money on them. Not so with our friends at Aston Martin. And now there's a new guy who's a billionaire, soon to be worth less because he's now as part of Aston Martin. I believe Tesla is a smaller scale of that because he doesn't make money on selling the cars. And I just hear the echo of Peter Drucker, if you know who Peter Drucker was. I met Peter Drucker and was with him 7 times. I went to seminars with him. And Drucker said, Sloan, who built General Motors to becoming the greatest industrial company in the world at the time, Sloan said, we have to make money on every single car. When they said, why were they caught flat-footed with new trends or things? It's because Sloan was making money on all the cars. Not so for some of the other manufacturers that he was competing against. So Tesla makes no money on the cars. In fact, he loses money. And if he didn't sell the clean air certificates to people, he wouldn't be making money. So my sense, when you say you think it's a bubble, I think somebody realizes eventually that he's not making money.
Right. Well, yeah. No, I think that's true. They also get an awful lot of subsidies, of course, which makes it even worse. But I guess my point is there are bubbles, and if you're in a bubble, there is no way to identify the top. There is simply no way. They say for the market they don't ring a bell at the top. Stock markets typically peak when monetary policy tightens. I think we're a long way from that. Okay. So the S&P will peak, and by peak I mean you look back 10 years later and that was a peak, or 5 years later or whatever. They peak when monetary policy tightens. But a bubble ends when you simply run out of buyers. Right. And you just run out of people who want to buy Bitcoin at 60,000 or whatever. Well, it's 35 now, but
so it's the greater fool theory. You run out of greater fools.
Yeah, absolutely. And so if you have something like that, it's always better to get out early, always. And if you look at bubbles, they have certain identifying characteristics on the downside, on the other side of a peak. On the upside, they have these they can be going up or flat and slowly up for a long time, but then they have exponential peaks, exponential moves, typically for 1 to as much as 3 years in some cases before the peak. After the peak, they will typically drop 30-50% almost immediately, and in some cases in a matter of days. Then they start to consolidate and they start to slowly move back up, and people say, wow, what a great buying opportunity. That is the most dangerous part of it. What a great buying opportunity. Let's get back in. And people say, well, I wanted to sell, but now it's moving back up. I'm not going to sell till we get back. Like gold in 1980 was a bubble. The last few months was a bubble. That was a very short move. I mean, it moved up from 1970, but when it was $35 an ounce, that wasn't. Moving from 35 to 100 or 200 wasn't a bubble. The end part was a bubble. Gold went from 850, I think it did one trade for 15 minutes at 850, but it went from 850 down to like 650 in a matter of 2-3 days.
Almost overnight.
And I can remember people saying, wow, this is a great time to get back in. Most dangerous thing. And so you see that, and then you see a long, slow decline. That is typical with bubbles. So the Nikkei, for example, the Japanese stock index, which is interesting because that's one of the broadest, largest markets or assets to ever be in a bubble. We're talking the Japanese stock market. Japan at the time, third largest economy in the world at the time after US and Germany, before China took over. Third largest economy in the world, and at the start of a bubble, the third largest stock market in the world. But the entire market was in a bubble. That's very unusual. Right. And anyway, where am I going with this? Oh, yes. So it peaked in 1989. Here we are in 2021. Your math's better than mine, but that's about 32 years, right? 33 years. Yep. The Japanese stock market is still today, in yen terms, lower than it was in 1989. So people who bought into that bubble are still underwater 33 years later.
Especially if you count in inflation of any kind, it would definitely be underwater. Absolutely.
Absolutely. And if people say, what about dividends? Well, as we probably know, Japanese stocks don't pay dividends of any significance. So yeah, they're underwater after all that time. The point I'm making is that you can have sharp declines initially, and then long, slow declines. And I mentioned gold. I'm a big gold fanatic, if you want, or gold bug, I don't care, whatever. But I like gold. But so I'll say something. 1979, 1980, the peak, it went all the way down to 1990. That's 10 years. No, 20 years. 10 years, sorry. That's a 10-year decline when it went all the way down to 250 or whatever. Right. I mean, that's a long time.
Well, and it took a long time to get eventually back up there and again inflation. Well, let's wrap this up by talking a little bit about, so where do you see then the next 12 to 18 months, not specific things, but do you see that since the world is awash in this money, that next 18 months we're going to kind of float along, using your water metaphor?
Are you talking economy or markets? Well, both really. I think we're going to continue to, float along, as you put it. I do. There's a old saying, there's a lot of ruin in a nation. And in fact, that's the title of a panel this afternoon that I'm on. There's a lot of ruin in a nation, meaning things can go on, even though logically, rationally, you look at it, you study it, you say, well, according to von Mises, this should have happened, this should happen, but they can go on a lot longer than you think, especially, say, a country like the U.S., which has such a underpinning of wealth. So you can dissipate that wealth over a period of decades. So it can go on a long time. But yeah, I think it's going to continue to float along. I mean, I'm perhaps, and the market too. Again, I think we're going to get volatility in certain sectors. So I think investors have to be much more nimble than they were. By nature, I'm a value investor. I'm a long-term value investor. I like finding really great companies where I say, gosh, this is a good price to buy it, and I buy it. And if there's no reason to sell it, I don't sell it. And I'll just give an example. This is not, I'm not, for the SEC purposes, I'm not talking about my money management here and past performance. But, we bought Nestle, for example, great company.
Right.
Boring company, some people would say, but a great company. Buy that 30 years ago at $30 a share. It's now $120 a share. The dividend you're getting today, based on that original purchase price, is like 7 or 8%. So over that period, have you done as well as Bitcoin or Tesla investors? No. You've made good money at very low risk. And I love buying good companies and just holding them. I think there's less of that we can do in the future, unfortunately.
So using the Graham model of finding undervalued companies, undervalued assets, and keeping them and letting them go through maturation.
Right. And Warren Buffett, who's not my favorite person because of his politics and his propensity to want everybody else to be taxed just because he doesn't pay enough taxes. And for goodness sake, if you think you don't pay enough taxes, Warren, just send a check to the Treasury.
They'll take it.
They'll take it. Don't get in my way. But he does say some good things. And, he said, if I have a good company and I sell it, he said 3 bad things happen. The first thing is I pay a commission. Well, you don't pay commissions anymore. But 2 bad things happen. One is I have to pay taxes on the gain. And the second thing is I have to find something else to do with the money. Right. So unless there's a reason to sell, a good company, just keep it.
Last question, inflation. So is inflation really going to hit us or not? Because I lived through that. My father owned a machine shop in the late 70s and in the 80s. He was there. I mean, he owned it past that. But we lived through crazy interest rates, and inflation was rampant. So what about inflation? Everybody thinks it's just a little bit of a spike. What's your take of it?
Yeah, I don't think it's just transitory, as they like. Excuse me. I don't think it's just transitory, as the Fed says. I don't know why they say transitory instead of temporary, but anyway, that's a different issue. It just sounds more academic. Let's use words that normal people don't often use because it makes us sound smarter. But I don't think it's just transitory. Yes, of course, there's what's the base effect. But I think 3 months now, you can't still keep blaming the base effect, right? And of course, you've got spikes with reopening. You've got supply chain issues. We all saw this, well, some of them didn't, but I mean, all normal people could see it coming. When you reopen, there'll be supply chain problems. There'll be certain sectors where demand comes back quicker than supply. Right. And they eventually catch up. So there's no question there's some of that. But if you look at two things, I'll just say, look at three things. First of all, pretty much everything is going up. So yes, you can talk about hotels, airlines, and used trucks and say, they're just temporary, don't worry about it. But go to the grocery store and pretty much everything is up. Go to the hardware store, everything's up. That's the first thing. The second thing is that the CRB index, commodity, of raw materials, the raw material index is up more than the wholesale price index, which is up more than the consumer price index. That means price increases are in the supply chain and are weaving their weary way. That was alliteration. That was good, wasn't it?
Good.
Weaving their weary way, I'll say it again, through. So all those wholesale prices are going to lead to increased consumer prices, and the raw materials input prices are going to lead to higher prices. And then lastly, wage rates are up and transportation costs are up. That affects every single price of a good or a service out there. Now, the guy that has a restaurant and has to pay, real example, $18 an hour for a dishwasher when his last dishwasher was only $12 an hour, right? He doesn't immediately change his menu and raise the prices.
Right.
But as each person there demands and gets a rise, if the new dishwasher's getting 18, why aren't I getting 18? Why am I not getting 18? As you increase wages, eventually those businesses' increase prices. The same with transportation. Transportation costs go up, that affects the price of everything. So for those three reasons, I think we're going to continue to see inflation. Now, is it going to get to 20% in the next year? I don't think so. I mean, I don't think we're at that point, but I do think we're going to see inflation go, from 4% to 5%, and maybe towards the end of this year, the rate increases come down a little bit. Right. But I think we're entrenched. This is a very conservative forecast. We're entrenched at more than 2%, which is the Fed's target.
Right. And the Fed's going to have to react at some time, or not. Maybe they just let the fire burn.
I don't think the Fed will act until there's a crisis. They will not get ahead of it. First of all, they don't believe there is inflation. Secondly, they're talking this nonsense about, we can have an average 2%. Average over what period of time, but I don't think they want. I don't think they're going to get ahead of it. So we need a crisis before they act.
Well, Adrian Day, this has been a fantastic conversation.
Thank you.
I really enjoyed it. And for all of you out there, if you have not taken notes, you need to go replay this. I think you need to take some notes because you talked to really a world-class mind about some very complicated topics. I really appreciate him taking the time to do this. And all I can say is I wish him great success in finding the best opera he can find here in South Dakota or wherever he is, because he turns out to be an aficionado of it. How's that for a fancy term?
That was good. Yes.
You know, almost the right English, and he'll keep me on the right thing. I know a couple of expressions,
well, it's Italian, but it'll work.
Okay, close enough. Well, but English,
we appropriated it.
Oh yeah, we read those. But anyway, Adrian Day is absolutely was a great guest, and I do mean you should go back through. You should listen to this, and here's what you should really understand: that this man has 30 plus years experience as a money manager, and his discussion about irrational exuberance, to use a phrase, is out there. So if you're out there and you're a speculator and you think that it's all easy money, you've just gotten your word of caution, a little bit of a wet blanket, if you will, but make sure that you keep your powder dry and preserve your wealth. And with that, I want to thank Adrian for spending so much time with us. Thank you, Adrian.
Well, thank you very much for having me. That was a lot of fun. I enjoyed it.
Excellent.
If you enjoyed my conversation with Adrian Day, I know that I was quite impressed. My whole team was impressed. I mean, people were taking notes, they were listening, and it was like, wow, can this guy talk just a little bit longer? So hopefully you got a whole lot of really interesting insights. By the way, just wanted to remind everybody that, the book, most businesses fail in the first 5 minutes. It just takes them 3 to 5 years to realize it. Position to Win. This book is now available again. We ran out of stock, but we now have more of them. Fresh from the press. And if you want a signature signed copy, what you need to do is go to positiontowinbook.com, positiontowinbook.com. You can buy them there, but you can also buy them at Barnes & Noble, Amazon, Books A Million, all kinds of places. You can also buy it at Kindle, Nook, and Apple Books. But if you want the real deal from us directly, go to positiontowinbook.com. Also, check us out on Facebook, check us out on YouTube. And all I can say is until next week, hopefully you're going to have a fantastic Raging Verbalist week and have a good one. Thank you.